Meet David. David built a successful landscaping company over 12 years. By last year, his corporation had $180,000 sitting in its business account. His accountant called it retained earnings surplus. David just called it his life's work. So David did what seemed totally logical. He transferred $180,000 straight into his personal bank account. 6 months later, he owed the government $74,000 in taxes he was not expecting. Not because he did anything illegal, but because nobody told him there was a right way and a spectacularly wrong way to pull money out of his own company. Today, we are going to make sure you are never David. I am going to walk you through all 5 methods, ranked from the smartest move to the one that will make your accountant physically wince. And by the end of this video, you will know exactly which one or which combination is right for your situation. Let us get into it. Here is something most people do not fully understand when they first incorporate. The money inside your corporation is to your money. I know, it feels like it is. You built the business. You signed every check, but legally, that corporation is its own entity. And the moment you want to move money from that entity into your personal pocket, that transaction has tax consequences. The question is not if you will be taxed. The question is how much, and that depends entirely on the method you choose. Over the next 12 minutes, I am going to break down 5 methods: salary, dividends, shareholder loans, the Capital Dividend Account, and coming in dead last, the one David used, just taking the money. We will cover what each method means, who it is best for, and the real tax math behind it. Stick around for method 4. Most business owners have never even heard of it, and it might literally be the most tax-efficient withdrawal you can make. Sarah runs a marketing agency through her corporation. Every month, she pays herself a $9,000 salary just like any other employee. Her corporation writes it off as a business expense. She pays personal income tax on it. Simple, clean, predictable. That is the beauty of salary. It works the way everyone's brain expects money to work. Why it is one? First, it is a deductible expense for your corporation. The company pays less corporate tax. Second, it creates what is called earned income. Earned income is the only thing that creates RRSP contribution room in Canada. If you want to max out your retirement savings, you need a salary to do it. Third, it also qualifies for CPP contributions, which builds your retirement benefit. Yes, you pay both the employer and employee portion as a business owner. That is real money, but it is also a government pension you will collect later. Salary is taxed at your personal marginal rate, which in Canada can climb to 50% plus at higher income levels. So if your corporation has a very profitable year and you pull a lot as salary, you could end up in the top bracket unnecessarily. The sweet spot? Most advisors recommend targeting salary that maxes out your RRSP room, which in 2026 means earning around $187,833 in prior year income. Then consider other methods for the rest. Back to David. Before things went wrong, his accountant at the time suggested he pay himself dividends. Less paperwork, the accountant said, taxed more favorably. David liked the sound of that. And honestly, dividends can be a great strategy. Here is how they work. When your corporation earns profit and pays corporate tax on it, you can then distribute what is left to yourself as a shareholder dividend. Because the corporate tax was already paid once, the personal tax rate on dividends is lower. This is called the dividend tax credit, and it is designed to prevent double taxation. There are 2 types. Eligible dividends, paid from income taxed at the general corporate rate, get a larger credit. Non-eligible dividends from the small business deduction income get a smaller one. The tax difference is significant, so your accountant needs to know which bucket your income falls into. Why it is too. No CPPP premiums to pay, less administrative overhead than running a formal payroll, and the effective tax rate can be meaningfully lower than salary at certain income levels. Catch, no earned income, no RRSP room. This is the biggie. If you only pay yourself dividends, you are building zero RRSP contribution room. Over a 20-year career, that could cost you hundreds of thousands in retirement savings. The winning move for most incorporated business owners. A blend enough salary to generate RRSP room, dividends for the rest. Your tax situation is unique. Run the numbers with an advisor. Next, meet Marcus. Marcus needed $40,000 fast. His daughter's university tuition. His corporation had the money. His personal account did not. His accountant said, "Take it as a shareholder loan. Pay it back within the year, and there is no income tax." Marcus did exactly that. Took $40,000. Life was good. Then Q4 hit. Business was slow. He could not pay it back. Come tax time, the CRA deemed that $40,000 as personal income for the PRR year. Now he owed tax plus interest. How it works. Shareholder loan lets you borrow money from your corporation. If you repay it before the end of the next fiscal year, after the year you borrowed it, it is included in your personal income. Zero tax. That is the rule. And it is merciless. Shareholder loans are powerful for short-term cash flow needs, bridging a slow season, covering a personal purchase when you know money is coming. They are also useful for owner-occupied home purchases in some structures, but they require discipline and tracking. Miss the repayment window? A full amount hits your personal income in the year you borrowed it, and the CRA will absolutely find it. They cross-reference corporate and personal returns. I want to tell you about a client we will call Linda. Linda sold a piece of commercial real estate through her corporation. Large gain. Half of that capital gain was taxable. But the other half? And frappelraden something called the Capital Dividend Account. Her accountant called her with news. Linda, you can take $190,000 out of your corporation, completely tax-free. Linda thought there was a mistake. There was not. How it works? In Canada, only 50% of capital gains are included in taxable income. The non-taxable half, that untaxed portion, accumulates in a notional account called the Capital Dividend Account. When you pay out a capital dividend to shareholders from this account, recipient pays zero personal tax on it. This is entirely legal, entirely above board, and entirely underused by small business owners. White fills the CDEDA. Capital gains from asset sales, proceeds from corporate-owned life insurance policies, certain gifts and inheritance is received by the corporation. Each of these can build your CDA balance over time. You need a CDA balance to use this. You cannot create it from operating income. And you do need to file an election with the CRA before paying the dividend. But if a corporation has ever sold an asset at a gain, or if you are planning to, this is absolutely something to discuss with your advisor. Back to David. Remember, David, the guy who transferred $180,000 to himself and got hit with a $74,000 tax bill? Here is exactly what he did wrong. He treated his corporation's bank account like a personal ATM. He transferred money labeled vaguely as management fees, with no written agreement, no invoices, no services actually rendered. He used the corporate credit card for family vacations. He had the corporation pay rent on his home office, an office he barely used. The CRA looked at all of it and said, "These are not legitimate business expenses. These are personal benefits. We are adding them to your income. Let us break down what went wrong. Personal use of corporate assets, using corporate vehicles, properties, or funds for personal benefit without proper compensation creates a taxable benefit that goes on your T4. You owe tax on it whether you declared it or not. Unsupported management fees. If your corporation pays a management fee to a related company or to you personally, there must be a legitimate written agreement and actual services rendered. The CRA scrutinizes these heavily. Shareholder benefits. Any advantage, benefit, or loan given to a shareholder that is not salary, dividends, or a properly documented loan can be deemed a taxable benefit under Section 15 of the Income Tax Act. The bottom line, there's nothing illegal about paying yourself through your corporation. Well, what is illegal, or at minimum, very expensive, is doing it sloppily, without documentation, or disguising personal expenses as business ones. The CRA is not going away, and their systems for cross-referencing corporate and personal returns are better than ever. So here's your cheat sheet. 5 methods. Ranked number 1. Salary. Use it to generate RRSP room and give yourself stable, predictable income. A must-have in your strategy. Number 2. Dividends. Pair with salary to reduce total tax burden. Best for years when you have already maxed your RRSP room. Number 3. Shareholder loans. Powerful but dangerous. Short-term only, with a firm repayment plan before you touch the money. Number 4. Capital Dividend Account. If it is available, it is the most tax-efficient money you will ever pull from your corporation. Ask your accountant about your CDA balance today. Number 5. Unstructured personal draws. Just not. There is always a better way. The right answer for you personally depends on your income level, your retirement goals, your corporate structure, and what province you are in. This is not a one-size-fits-all situation, but now you know the landscape. David, by the way, he spoke to our certified financial planner, restructured his compensation plan, and now he is pulling money from his corporation efficiently and legally. His effective tax rate on his withdrawals dropped by over 18 percentage points. That is the difference between knowing this stuff and not. If you found this video helpful, here is what I want you to do right now. Grab a notepad, or just open your Notes app, and write down 3 questions to ask your accountant at your next meeting. 1. What is the optimal salary dividend mix for my situation this year? Hector, will I have a capital dividend account balance I can access? Free. Are there any shareholder benefits on my current setup that could create tax exposure? Those 3 questions alone could save you thousands of dollars this year. If you have questions, drop them in the comments. I read. And if you know another business owner who is winging their compensation strategy, send them this video. You might just save them from becoming the next David. I will see you in the next one. If you live in Ontario and want to save like wealthy retiree, scan the QR code or click on the link in the description to see if we are a fit.